This is the Lebenthal Report with industry veterans Michael Hartzman and Dominick. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, November 14th, 2023. And while we had some very capable co-hosts the last couple of weeks, we got the OG back in the house. Dominick, welcome back.
Thanks for allowing me to come back, Mike. I been on a hectic travel schedule the last couple of weeks, and I know you've had some very, very capable stand-ins, but happy to be back.
We're happy to have you back, and I will have to tell you that your friend Scott, my son, and David Walker did admirable jobs in your absence, but we are happy to have you back.
Yeah, and maybe the timing of it is kind of incredible. We've had a pretty volatile market over the last couple of weeks. So you can argue all year long, but last couple of weeks have been really volatile, and for a pleasant change of pace on volatility on the upside. So we'll take that, Mike. We'll definitely take that.
Yeah, absolutely. You know, I did an article for a friend of mine on his LinkedIn page, and the headline I wrote was "Good news is finally good news," because for a long time the market would go down, you know, on good news, and that was always very frustrating. But before we get to that, you know, Dom, tonight's show is just going to be me and you. There's been so much going on with the market, and we kind of do this a couple of times a year. We thought it was a good evening just for you and I to have a nice little fireside chat and just talk about what's been going on. You're right. It has been very volatile. 3 weeks ago, we got a blowout number for the gross domestic product for the third quarter. It was up 5%. And most people would cheer that, but the market basically sold off. I got a little nervous about that. And that's when good news was bad news. And lately, Dom, you know, the economy is showing signs of finally cooling off, which again is not necessarily good news if you're in danger of losing a job, but it's good news as it relates to the Federal Reserve, because the story this entire year, and really, Dom, since the middle of last year, the story has been about interest rates. And it appears, hopefully, that the market's starting to believe that that story is about to change.
Yeah, if we can end with we'll end with the story first and then go back to the beginning. It really does seem that there's a strong possibility the Federal Reserve is done raising interest rates. And so they may or may not be done. But if they're not, Mike, I think you would agree they're pretty close to being done. Maybe one more slight rate increase the balance of the year. But you and I have been saying for a long time, they're done, or at least they should be done. And based on the inflation data that we got this morning, again, a very definitive path to lower inflationary numbers. And that gives the Federal Reserve some latitude to go, hey, we can be patient here. We don't need to raise rates or raise them aggressively. We can let the economy coast to a continued slowdown, and hopefully not off the cliff.
Hopefully, wow, that's a great way to end the story. Hopefully not off the cliff. And I think what you mean by that is hopefully not right into a recession, right?
Correct. Thank you, Mike. So I left that open-ended intentionally because you and I have been doing this way too long and pretty much can finish each other's thoughts and sentences. An old married couple here. But the reality is, if we could go back to the end of July, we were kind of in a euphoric state. And then, as you have said many times, good news was actually bad news. We were getting good economic news after good economic news. And the fear that most investors in the markets in general had was that the Federal Reserve would have no choice but to continue raising interest rates, higher credit card rates, higher mortgages. We saw mortgages peak out at 8%. Mike, on a 30-year mortgage,
Mm-hmm.
higher car loans, right? And real fear in the market, small businesses that are very dependent on loans either couldn't get loans at all or would have to pay extraordinarily high interest on those loans, all of it putting pressure on the economy and perhaps so much pressure that it would eventually go into a recession.
And so what is happening now, and look, experts have been saying for a long time that the feds have to thread this needle, and maybe they are actually threading this needle because unemployment has not cratered. As I said on the open, the GDP, the gross domestic product, grew by 5% last quarter, which under any circumstances, people are going to cheer. It's a
We'd be
phenomenal
cheering.
number.
We'd be popping champagne bottles. We want the economy to grow. We want the employment numbers to be lower. We want people to have jobs. We want earnings, wage earnings to go higher. But again, good news, bad news. I keep stealing your line, Mike. Good news in this case, economic news means that the Federal Reserve would have no choice but to continue aggressively raising interest rates. And now 3 out of the last 4 meetings, they've hit the pause button. And that's been extremely positive over the last 3-4 weeks or so.
And not only, you're right, obviously, but not only did they hit the pause button, is the Federal Reserve translators, because the Fed chief speaks and so do his governors in very measured terms, they've interpreted that they might actually be hitting the pause button for a longer period of time, not just this last meeting, but as you said, maybe for the rest of the year, and maybe just done with this cycle entirely.
Yeah, Mike, not that I can tell them what to do or you can tell them what to do, but clearly there's been many market experts, economists, and some of our favorite people out there that are going, hey, you've done enough, right? It takes a long time for these higher interest rates to kind of feed into the economy, right? People are not buying houses every day, people are not buying cars every day. It's only when they actually are ready to go do it, they're confronted with this higher interest rate environment. And that means that people start to hit the pause button. And so it takes a long time for these higher rates to feed into the economy. And so you have to give this restrictive policy that the Fed has put into our system time to take effect. And there is that danger that they would do too much. For a while now, many experts have been saying, hey, hit the pause button. Let's see how far you've done, how much damage you've done to the economy. And if you need to do more, you can do more, but don't overdo it. Perhaps this is it. Hopefully they've done it. I'm genuinely hoping that they don't raise any more because I don't think the economy is done slowing down.
You don't think the economy? No, neither do I. And let's just go over the numbers real quick.
Sure.
Give us some context. So quarter to date, the S&P Standard & Poor 500, excuse me, was up 3.12% through Friday, November 13th. For that 1 week, it was up 1 1/3%. And I think, Dom, it's already up another 1 and change today. Had a great day. The S&P year to date is up about 18%. The NASDAQ is up about 35%, up about 4.5% this quarter. And the Dow Jones, which is kind of the value stocks, dividend payers, the kind of the laggards sometimes of the big companies, is up only 5 and change and 2.5% this year. But just to go back in time, what was the S&P up between January and July? About 22% or 24%?
Almost 20%. And I'm glad you brought that up, Mike, because the S&P at the end of July, that was up plus or minus around 20%. By the end of, I think, October, was up less than 10%, had basically given up about half of the profits for the year. And the NASDAQ equally had given up about half of its profits. And here's a shocker. the Dow was negative for the year. The Dow actually had gone negative. So we had gone from a very kind of euphoric environment, the end of July, to kind of some really, I know we were looking at that finish line going, and for our purposes, it was about 4,200 on the S&P going, wow, this might get bad and it might get really bad, right? We not only would we give up all the profits for the year on the S&P, we'll focus on that like the Dow did, but we might go negative if this keeps up. And certainly some experts out there were talking about negative by December 31st, Mike.
Yeah, no, I know. And they kind of backtracked a little bit. But Dominic, I want to go back to the S&P for a minute. It's something that I think my clients are sick of hearing and your clients are sick of hearing. The S&P being up 20%, and that was the number, was a little bit smoke and mirrors.
A lot, Mike. A lot smoke and mirrors.
And
Can I stress that?
Yes, you can. And the reason it is because, those 7 or 8 stocks, they've been called, I think they've been called the Magnificent Seven. Not going to name them here, but the market weighted S&P 500 basically pulled the other 493 stocks along with it, those 7 stocks. So, and the equally weighted S&P 500 basically was flat. So I want you to do a little economics 101 and explain for a minute, if you could, which I know you can, the difference between the market weighted S&P, Dom, and the equally weighted S&P, and why there was such a gigantic disparity.
So let's just start with looking at the actual numbers, right? The S&P, as you pointed out, after a fantastic day today, is up around that 17, 18% number. Mike, take a wild guess what the equal weighted S&P is up for the year.
About 1%.
Great, Mike. 0.89. So I'm going to give you that one. I'm going to give you. So wait a minute. How can the equal weighted S&P be up after a fantastic day today? A whopping 1%, but the SPY, the regular S&P quote that we watch on CNBC every day, the market weighted S&P be up 18%. And that's the Magnificent Seven.
Mm-hmm.
These are 7 stocks that are so large. Think of a scale. They're sitting on the one side of the scale, and the 493 other stocks are sitting on the other side of this scale. And these 7 stocks are so large, their weight, their size overwhelms the other 493 stocks. So when you look at it from their sheer size and weight, those 7 stocks were up before today 95%. 7 stocks up 95. That weighting basically carried the load for all these other stocks. If you take all 500 stocks and divide them equally in the S&P 500, the entire S&P is only up a whopping 1% for the year. And so if these 7 stocks are up so much, it really has to tell you that the other, or a large number of these other stocks, are actually down a lot. Yeah. Right, Mike?
Because I think those 7 stocks, and I shouldn't wing it, but I think these 7 stocks represent 40% or about 40% of the S&P weighting.
Yeah, I think at one point, Mike, before today, it was around the 30%. But to exactly your point, they've grown so much this year alone that the weighting now has gone, I think it's close to 40%. Yeah. So, people are looking at the markets like, oh, the market's having a great year. And then I go, well, no, these 7 stocks are having a fabulous year. But the other 493 are somewhere from, they're having a good year. In some cases, having a really, really, really horrific year, right? So, and it's all about this economic recovery and recession and higher interest rates, but it's not uniform. It's not all stocks. It's a very, very concentrated handful of stocks that are having a good year.
But glass half full, let's talk a minute about the earnings that we just got done hearing about. We're about 90% through the earnings season. And the earnings haven't been bad for the S&P 500. I think the number is plus 4.5% on a year-over-year basis. So again, Dom, this is where the Fed might be threading this needle where, yeah, the S&P in general has been flat, but the economy has not been terrible. And this is my challenge every day, Dom. I have the conversation with my clients. The economy is terrible. And to try to explain to them, well, the reason interest rates are so high and they keep raising them because the economy is not terrible. And then I get looked at like I have 7 heads. So would you please, tell me if the economy is terrible or not?
No, I think you're spot on, Mike. The economy is not terrible. Now, we did come into this year with expectations. And in fact, the expectations, you might remember, and we can remind our listeners, many of the experts were talking about a recession this year.
Lower interest rates by now. Lower interest rates by now.
Lower interest. The Fed would be cutting at least 2 or 3 times. What was the GDP number last quarter, Mike? What was that number?
4.9%. And just for the record, Dom, we are on the record a year ago saying that was crazy talk.
Yeah, we did not believe that we would be in a recession, and we certainly did not believe. Remember, the Federal Reserve would, in my opinion, and I think you agree with this one, Mike, the Federal Reserve would only be cutting rates if we were in a recession. Mm-hmm. And to steal your words, if you don't mind me doing it, Mike, be careful what you wish for. Mm-hmm. Because if you want lower rates, it means the economy, sorry about the line, has to fall off a cliff, has to go into a recession, right? Mm-hmm. So back to where we left off, the economy is not in a recession. That's the good news. The bad news, you can argue, is that it's clearly slowing down. Yeah. We look at things like retail sales, unemployment numbers have gone up slightly, wage growth has slowed down. There are a lot of factors that are showing us the economy is slowing down, but it's not in bad shape.
And that's a dichotomy, because that's what the Federal Reserve wants, right? They need to and want to slow down the economy because it's the only way to break the back of inflation.
And if I could just put an exclamation point on what you just said, Mike, by slowing down the economy, they get the consumer to stop spending.
Okay. When does the consumer actually stop spending unless they're unemployed, Dom?
Or, and I agree with you 100%, or are afraid that they might be unemployed, right? It's that fear.
I agree with you. And again, this is something we sound like a broken record. I've had one client this year who actually got laid off, and she wanted to. And I have not had a single client express job insecurity to me all year. Not one. Have you?
I want to go in full disclosure. Maybe I've had 1 or 2. Okay. And maybe, like you, I'll say maybe somewhat their choice as well. Hey, it's good time to take my retirement. It's a good time to do switch jobs, right? Good excuse. Mm-hmm. Companies offer me a buyout. And we are seeing a lot of that, Mike. We are seeing companies going, hey, we do need to trim. And that's, by the way, how they increase their profits. They just cut their expenses. So we're seeing a little bit of it, but not the wholesale rise in unemployment, which is what the Federal Reserve was expecting, and a decrease in economic growth, otherwise known as a recession, not happening so far.
So let's do this. Let's fast forward a year from now. The presidential election would have been over. I think the Federal Reserve is perfectly happy to be on the sidelines as an election gets closer and closer and closer. But I think what's interesting is we have a conservative Republican who's the Fed chief, who's appointed by a Republican president and retained by a Democratic president. And the Fed says they want to be neutral. They just want to do what's right for the economy. But if the economy improves throughout 2024, we avoid a recession, that does bode well for the person in the White House currently. So it would be interesting to me, Dom, as we get closer to the election, what the Federal Reserve does, what the timing of it is, what's your thought on all those different variables?
So to the extent that you believe it or the public believes it, the Federal Reserve tries very hard not to be political.
I know.
They try to make their decisions in a way that doesn't have a political bias to it. In fact, during congressional hearings, they get the congressmen and senators try to box them in all the time. And I think Chairman Powell does a good job of going, not going there. That's not my job. You guys deal with that. Having said that, if we want to be honest with ourselves, the first question is, where is inflation going to be a year from now, 3 months from now, 6 months from now, 12 months from now? And then, quite frankly, I think it'll be quite easy to go, this is where the economy is going to be, this is where interest rates are going to be, this is where economic growth is going to be. So it's kind of hard to come up with the answer to those questions if you don't know where inflation is going to be. My belief is that although you might get some kind of intra-month or intra-quarter mini spikes in inflation, that overall I do expect inflation to be lower a year from now than it is today. I think this cycle continues month over month, quarter over quarter, where inflation, even if it's slightly lower like it was today, inflation is slightly lower next month, next quarter, and 6 months from now than it is today. And that takes the pressure off the Fed to have to raise interest rates.
Right. And depending on who's in the White House, you either take that as good news or bad news, depending on who you're planning on pulling the lever for. But at the moment, it would bode as positive news for the current occupant. So let's move on. The market's been hyper focused on interest rates for a very, very long time. There's still other things to worry about, right? There's obviously the ongoing war in Ukraine, the war in Israel. People are always worried about China, Biden's meeting with their leader, I think today or tomorrow. So once we get done worrying about interest rates, Dom, there's other things we have to worry about. It's just human nature. So what do we worry about? What do we worry about next?
For me, Mike, and again, we're going to take the interest rate / inflation question off the table right now, and I think we can. It's really about earnings. As the consumer does continue to slow down their spending, and I'm not saying they're going to stop, but they clearly are slowing it down, it's going to get harder and harder and harder for the markets, the S&P 500, to sustain its earnings. So you brought it up, Mike. This last quarter, earnings have been pretty good, but we've brought this up quarter after quarter after quarter all year. The expectations for earnings have been lowered, right? We started the year with the market expecting the S&P to earn about $235 for the entire S&P 500. I think right now we're about 219. So we've seen about a 10% or so correction in earnings, and we are beating those lowered expectations, but they definitively are lower than they were on January 1st. So the $1 million question is, where are earnings going to be next year? And it's pretty hard to see the market's going substantially higher if we can't get earnings to go substantially higher.
And our friends at JP Morgan agree with you. Just reading a note that they sent us yesterday. It says, at the moment, the weaker than expected guidance falls in line with our view of 2024 earnings expectations as being overly optimistic. The current consensus estimate is for operating earnings to grow at negative 12% in 2024, and we see operating earnings per share growing in the low single digits with the possibility of further downside. So again, if we get that negative sign, that's a typo. They say that other experts are expecting 12% growth, and JP Morgan is expecting single digits.
So at the risk of, we don't want to call anybody out publicly here, but we had a very, very well-known Wall Street analyst who was predicting earnings in the $180, $190 range, and therefore a very, very substantial market correction. And that's what you and I have been talking about pretty much the whole show. That hasn't happened, right? Earnings have held up pretty good. The consumers held up pretty well. Companies have done a good job of cutting expenses and keeping those margins higher. But if we can't get earnings higher or growing at a faster rate than they are right now, then it's going to be difficult for us to post new highs. It's believed by some of these experts that this will kind of be the trough in earnings this quarter, the fourth quarter, and then we could start to see earnings growth with the first quarter of next year. So it really, can companies continue to make money? Will the consumer hold up? Those are really the tough questions to try to project, Mike.
Well, again, we are just in the beginning of the Christmas shopping season. So I think for this quarter, Dom, yeah, even people have some job insecurity. They'll continue to spend money through the Christmas season. That's typically what happens. It might slow down, but this is usually the quarter the most retailers, online or brick and mortar, this is the quarter they make their money.
Yeah, and Mike, we could joke about it, but the American consumer will find a way to spend money if they can. And, we can look at things like consumer debt, and it's the highest I think it's ever been. Consumers have taken on more credit card debt and more loans in the history of this country, but yet they really haven't. If we looked at retail sales, they really have not slowed down all that much. And frankly, I expect that spending spree to continue at least through December 31st. So I think we're pretty safe through the end of this year at this point in the game. The $1 million question is going to be next year.
Yeah. You're right. If consumers have a nickel, they're spending a dime. There's no question about it.
And the sad part, Mike, is they're borrowing that extra nickel at incredibly high interest rates so that they can continue that spending spree that they're on.
Glad you brought that up. I want to talk about that when we come back from the break. So good, lively conversation for the first half. Let's take a break. Let's catch our breath, and we'll be back in a few minutes.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner, Dominick Tavella. No guests this evening, Dom, just you and me having a nice friendly chat, solving the problems of the world in a quick 50-minute conversation.
And I think it's healthy for us to do this every so often, Mike, because maybe you and I can explore some of the questions we're actually getting from our own clients, right? You and I are both dealing with clients on a daily basis, multiple times a day, and dealing with their issues, their questions, their frustrations, and what they're watching. We talk about headline risk all the time, right, Mike? They're looking at what's going on TV, and if you're not frightened, you're not paying attention. So maybe it's a good idea for just you and I sometimes to have a fireside chat and discuss some of these issues.
And let's talk about something that's never talked about on TV that seems to be this insidious, disease that is affected by every consumer who uses a credit card, Dom. I've noticed lately that the average interest rate on a credit card, if you have a balance, is between 20 and 30%. And if you pay your bill late, it could be over 30%. And it's just so important for people to pay attention to, not running up credit card debt. As you pointed out, they're doing it quicker than ever. And looking at those interest rates, Dom, because at those rates, you're never going to be able to pay those bills off.
Not only never pay it off, Mike, but think about it. It accumulates, it rolls over, the hole just gets deeper. And that is one of the fears that we're looking at, that many analysts and economists are looking at, going, hey, it's an issue today, but it could be a major problem tomorrow, because at some point that consumer doesn't have a choice. They either can't pay the bills, they can't dig themselves out. Bankruptcies go up, business bankruptcies go up. And this is the snowball that, when it's at the top of the hill, it doesn't look like that big a deal. But as it continues to roll down the hill, roll down the hill, roll down the hill, it gets larger and larger and larger, and eventually it has no choice but collapse under its own weight. And I think that's a genuine fear that we need to pay attention to.
Yeah, and when people, a lot of our clients, a lot of my clients have they have home equity lines of credit, and they complain to me constantly that the rate went from, I don't know, 3% to 7%. And that's a big jump. I'm not saying it's not a big deal. It's a big deal. But they never mentioned to me the consumer debt they have on their Visa, MasterCard, American Express. And those rates could be double or triple. So I guess our message tonight, Dom, is just pay attention to that and be mindful. And it's just as I said, there's just disease in everyone's financial life that seems to get ignored.
Look, Mike, and I'm experiencing it. I got to believe you're doing the same thing, where, people took out these home equity loans, right? They did home improvements. Maybe they bought a car. Maybe they bought a boat. Maybe they helped finance their children's college education. At 2-3%, you're not really terribly worried about it, right? But now it's 7, 8, 9%. I even had a client call up with a 12% home equity loan, and whoa, wait a minute. And so the phone calls are coming, going, I need to make withdrawals out of my accounts, out of my portfolio, worse, out of my IRA, which is a taxable event. Now they got federal taxes, state taxes, possibly, penalties, possibly.
Mm-hmm.
I need to pay these credit card debt amounts off as quickly as possible, because the interest rate that I'm paying is unsupported. Can't do it. Can't pay it off just using their salary. So it is a huge problem today, and honestly, Mike, likely to be even substantially larger after December 31st, after the holidays.
I had a relative call me looking for advice because they were paying 29.5% on their Amazon credit card. And I said to them, that's impossible. How is that legal? And they said, well, I'll go check. And they called me back 5 minutes later and said, nope, I'm paying 29.5%. And when they asked the person to lower the fee, the actually answer was, why would we lower your fee? You never miss a payment.
Look, and that's kind of, I want to say, good advice. At least call the credit card company and ask them to lower it. Most of them will do some kind of courtesy amount for a certain period of time. Hey, we'll lower it by 2-3% for the next 6 months. But if you don't call, they won't, right? If you're making those payments on time, they'll be gratefully happy to take your money, right? And I mentioned it during our break. There's a pretty well-known retailer out there that actually makes more money off of the credit card interest than they do selling their product, right? So it's almost like they sell the product as an excuse to have the credit card balance high, so that they could collect the interest on that credit card. So, Micah, that might be the best advice you've given tonight, at least. Please look at those balances, look at the interest rate that you're paying on them, and let's figure out if we can help you. Let's figure out how to pay them off, or pay them off early, maybe systematically over the next couple of months, 6 months, but let's figure out a way to aggressively hit those credit card balances.
Good advice. And Dom, if we learned anything in 3 years doing this podcast, we learned how to do a segue. So let's segue from consumer debt to the government debt. And you and you've mentioned a couple of times, falling off a cliff. What do you think is going to happen? Do you think they kick the can down the road? Do we get a real deal? Do we get this little revolt again from 8 Republicans who don't want to seemingly do anything? What's your prediction with the government debt that they have to, re-up any day now?
Yeah, Mike. So let's start with by saying, it's not one administration; it's the last two.
Yeah, kick the can
Republican
down the
president
road.
and
Yeah.
Democrat. So I'm not here to throw stones at one or the other, but it's just unfathomable. We're talking about our clients and at least they have assets and we can help them pay. They have real jobs, they make money. We can help them pay down their debt. We have a government that is, to say they've been acting like drunken sailors is an insult to drunken sailors. They've been spending money at an unfathomable pace, borrowing the substantial majority of it. And now we're in an environment where the interest payments alone, I think this year might be close to $800 billion. Mike, am I in the ballpark?
I'm pretty
Now,
sure you're in the
just in
ballpark.
context, that is more than we will spend on national defense.
Yeah.
Think about every aircraft carrier, every plane, every soldier, every army base, every paycheck that we pay our military, every benefit that we provide these people that put their lives on the line for us. We will spend more in interest payments than our entire national defense. And we're at a crisis moment, Mike. We are definitive. I don't care how they wrap it up and put a bow on it. The reality is we are at a crisis moment. I'm not defending one party or the other or blaming one party or another, but they clearly have to get the total amount of debt to grow less fast. I'm sure that's not proper English, Mike, than our economic growth. We have to get the tax revenue and the economy growing at a faster pace than our spending, or we'll never turn this ship around. We'll never turn it around. And the implications are really a national security implications. We're putting our country at risk. There's no other polite way to phrase it, Mike. And I don't think I'm being overly dramatic.
I don't think you are either. And wouldn't that be also part of the government's agenda to lower interest rates? Because treasury bonds, Dom, are you could buy 6 month, 1 year treasury paper for paying 5%. So don't they have to get interest rates down in a self-serving manner as well, so they can issue paper at a cheaper rate?
That's a great point, Mike. That is, I'm glad you brought that up. That is, so they're not supposed to be political. They're not supposed to be dealing with these kind of issues. But frankly, the more they borrow, the more, because they're paying interest on that money, the more they have to borrow. So by the Federal Reserve raising interest rates, those interest rate costs get even higher, which means they have to borrow more money, which means the interest rates go higher. So it's some people have labeled this as the debt spiral. It just is inevitable that it just gets worse and worse and worse. But I don't know that the issue can be solved, but it can be made better. But you need some real strong political will to do this. And again, both sides, Mike, of both parties, it's not just one or the other. Will they have the courage to do the right thing for the country? I don't know. But spending increases have to be at a lower rate. The increases have to be at a lower rate than they've increased over the last couple of years. And I don't know if they get it, Mike, until it's too late.
I don't, Dom. I think there's a pattern now of there's a culture of bailouts. There's a culture of just throwing as much money as possible. I think it started in 2008 with the financial crisis. And I remember hearing then the way to solve a problem like this is take a fire hose, throw as much money at this problem as we possibly can, and we'll worry about it later. And I think
the only problem, Mike, with your analogy is the fire hose was spewing out gasoline.
I understand.
It wasn't spewing out water. So they literally were pouring gasoline on the fire, by definition, created all this inflation that we're discussing this evening. And there on the other side, you have the Federal Reserve with a garden hose going, oh, we want to put a little water on this fire. And
Well,
guess what, Mike?
no, I'm talking about the 2008 crisis, not the 2020 crisis, where they did it
Again,
again.
both parties, Mike, they were pouring
Mhm.
money into the economy, and I understand it. I'm not justifying it. Hey, we were dealing with a COVID. We were dealing with the entire, not only U.S. economy, but global economy shut down. We can't have the economy collapse. But at some point, you have to be fiscally responsible and go, hey, have we done too much? Have we done enough? Maybe we should slow it down. No, it was a perfect excuse for both parties to spend with basically no reservations. And I'm sorry about the analogy. On the other side of the bonfire was the Federal Reserve with a garden hose trying to put the fire out. Well, it didn't work. It didn't work, Mike. And now we're at a point where if they don't do something soon, it may never work.
So what's your prediction? Do they kick the can down the road for another 6 months and make it, the next person, or a year, make it the next person's problem? Because Dom, I don't see, the way politics works right now, I just don't see enough people in the middle willing to be adults and getting a real solution and not just putting a Band-Aid on it.
Yeah, Mike, I would love to argue with you on that point. I would love to go, no, Mike, you're being negative, you're being a pessimist, but I think you're exactly right. And unfortunately, I think you're exactly right because they're going into an election year.
Mm-hmm.
So do you really believe that any party is going to come along and go, whoa, let's be fiscally responsible, let's cut spending when they're trying to get reelected?
And no one wants to give the other side anything that could be perceived as a win. God forbid the other side gets a win.
Look, and I'll pick on one really, really touching the third rail of politics. We know that both the Social Security system and the Medicare system are basically, well, they're broke now, right? Technically not, but they're just spending every dollar coming in, goes out the door. And eventually that's unsustainable. And over the next couple of years, some solution has to be found. And those solutions are pretty common sense, right? They're going to increase the age of retirement. They're going to look at high income earners and say, hey, we're going to cut back your benefits a little bit. So the solutions are common sense. They're there. And, the Medicare system, the Social Security system are there to really help people who don't have as much as others. But nobody is going to talk about that, Mike, and trying to do the right thing during an election year, because the other party will literally fry them. The other party will run commercials and bury them. So that whole thing will be kicked down the road at least until after the election. So another year with nothing being done on that particular issue.
So we're not going to solve that problem tonight. But that's a great synopsis. I couldn't agree with you more. So let me ask you this, Dominick. If things are getting back to normal for the stock and bond market, and we could just have, garden variety problems next year and not be hyper focused on interest rates, the whole concept of 60-40 investing, 60% equity, 40% bonds, or 50-50, that was broken for 2 years. Last year was an unmitigated disaster.
If you had a very, very, very well-known money managers, and we know some of these people, Mike, these are bright people, but bonds were wrecked last year. Stocks were wrecked last year. And what you consider a very boring 60-40 portfolio was down 14 to 18% last year.
Right. There was nowhere to hide.
Nowhere to hide.
And this year has been better. The S&P's up, the markets are up, the bond market's been blah, nothing great. So my question for you is, do you see the old concept of 60-40 getting right-sized again and kind of things becoming a little bit more stabilized and normal, where we could create normal asset allocations and kind of expect something to be working as opposed to nothing working?
Yeah, Mike, I think that's a great question. So what really, we're used to the stock market going through this kind of volatility, but the bond market has been the stable part of our portfolios. And bonds got wrecked last year because interest rates went higher, and this year they're higher still. And so bonds have underperformed for basically the last 2 years. If we see interest rates start to roll over and come down, then not only will we be collecting the interest on those bonds, but the value of those bonds will go higher. And one kind of dumb example, today alone, Mike, the 20-year Treasury was up 2.27% in one day. The value of that bond went higher because interest rates went lower. You made 2.2, almost 2.25% in one day.
And Dom, just be clear, when we first started out in the business, that would take a whole year to happen.
Oh my God! Literally, 3-4 years ago, a 20-year bond would pay you 2% for a year in interest.
Exactly.
So that's an anomaly, because we did have interest rates dramatically go lower today. The 10-year is under 4.5%. So assuming that we continue this pattern of lower interest rates next year, we should get some appreciation in value in the bonds. Plus, we'll collect a pretty good interest rate. You've talked about those higher interest rates, Mike. So I think a traditional 60-40 portfolio, at least for the foreseeable future, will perform well. Where it underperformed the last year to 2 years, I think at least for the next 12-18 months, that traditional portfolio should perform pretty well.
Yeah, I agree with you. And then let's talk about municipal bonds for a few minutes, Dom, as we get towards the end of the show. Municipal bonds are super important for us. We're in a high tax state, and again, muni bonds got wrecked along with other bonds last year as well. And this year, up until this week, the bond market was actually down. And if the bond market, happens to close down for the second year in a row, the muni bond market, that has never happened in the history of the municipal bond market. So again, when we see the short-term rates start to come down, the yields not as juicy as they are now, maybe municipal bonds become attractive again for our clients.
Yeah, Mike, and I can't do one of these discussions with you if I don't use the word wonky. So at the risk of getting wonky, these bonds did not default, correct, Mike? They didn't go out of business. The Port Authority, the XYZ Municipal Authority did not go bankrupt. So these bonds continued to pay their interest normally. Investors collected their interest normally, but because interest rates went higher, the value of that bond went lower. It just behaved like a seesaw, right? So if you bought a bond on January 1st of this year, a municipal bond, a terrific bond, you collected all your interest, but the value, if you went to sell it today, would have been less than what you paid for it on January 1st of this year. I want to go for the first time. I might be wrong, but I think for the first time in a long time, the value crossed over on the plus side because, again, interest rates have started to roll over and come down. So the value right now, I just put up one of our ETFs, is up about 0.5% for the year. Nothing to do with the yield. This is just the value of that bond. So I do think that trend continues. And as a bondholder, maybe you're finally going to get some relief.
And I think that relief, Dom, could be sustainable and not only get relief. I think clients just want things to get back to normal, right? Because last year was the worst bond market we had in 40 years. And again, followed up with one that's been basically, blah. So I just think clients want to get back to normal and have confidence that they could buy a municipal bond and not lose 10%. And I think we're there.
But Mike, what is, and this might be a show for another evening and an entire show, but what is normal? because we were near zero interest rates for a very, very long time. And now we know the Federal Reserve has raised interest rates way high, and hopefully they'll roll over and come back down. But what is normal 3% interest rates, 2% interest rates, but it surely isn't zero interest rates that we
Dom,
had.
I think normal, as the expression goes, you ask an old bond trader what they expect, and they say, well, if the client just clips the coupon, they'll be fine, referring back to when you actually clipped coupons. So I think normal, Dom,
I think you
if you're
dated yourself and me as well. My clip a coupon. What is that? But again, we'll put that off to the side.
Thank you. Yeah, we both have birthdays coming up. Thanks. I think normal is for a municipal bond investor, they don't expect to get rich. They don't expect to get poor. They just want their coupon. They want their dividend. That to me is, the answer to your question, the definition of normal.
Yeah, the volatility has been really, especially for our clients, we tend to think of ourselves as boring as mud. We run pretty conservative portfolios, but the volatility has been extraordinary these last couple of years. And maybe just an environment where these roller coaster rides are not as extreme would be welcome news, Mike. I know it would be for you and me.
Oh my God, absolutely. So listen, we got about a minute or two to go. Any closing thoughts on the volatility that we've had and the little mini rally we're enjoying at the moment?
So, it's not revisionist history, Mike, but both you and I have been saying, we normally go through a historically bad period, that September, October time frame, and then maybe we find out earnings aren't quite as bad as some projected, and we get a little bit of a Christmas rally or a holiday rally, as some people call it. It does seem that maybe we are setting ourselves up for that, and that would be welcome, Mike. Get a little relief from the volatility this year. We get a little bit of a rally through the end of December. We can put a bow on 2023, and then hopefully look forward to 2024. So look, we started over the last couple of weeks this year-end rally, I'm going to call it, and I'm obviously hoping we can sustain it for the next couple of weeks and finish out this year.
I agree with you. And as you know, Dominic, we both know Santa Claus personally, and we're going to see him in a couple of weeks. So we'll ask him his opinion, whether we're going to have a Santa rally or not. But look, on that note, let's finish up. We're going to be off next week for the Thanksgiving holiday. And Dom, have a great Thanksgiving with your family. Be safe, and to our clients as well.
You as well, Mike. Give my best to all and to all our clients. And happy Thanksgiving, everybody. If we don't get to speak to you, please be safe. And we'll get through all this as we always have. So have a good night, everybody.
Have a good night. Take care.